All right, we got a great show today. We're going to be talking about beyond the yield, specifically when it comes to dividend stocks. Okay, now before we jump into what we're going to talk about today, I really want to get your thoughts on what you think the biggest misunderstanding happens when somebody hears or says the term dividend stock.
The company itself is not going to grow. It's just going to pay out some dividends, and the share price is going to stay the same.
Boring.
It's boring.
Boring.
No
That's right.
growth.
There's no sizzle.
It's just going to
So
pay a
conservative.
very specific rate, like 5%, and then the stock's going to be flatlined.
Yep.
Right.
And then what your payout is, what you get from a dividend, is always tied to what the stock price is doing.
So if the stock price is $100, it pays you $5, and if it goes down to $50, it pays you $2.50.
Pays you $2.50. Yep. It's always attached.
That's a good observation there.
And if I'm young, I shouldn't even get into that for 20 more years.
Oh, so dividend stocks are only for old people.
Only for
That's
old
right.
people.
Yeah, that's
But
what my
what
grandmother
does everybody
used to do.
compare it to? Oh, I want to have the next Amazon or the next Apple.
Yes.
I want that sizzle.
I want that flashy.
500%
Yeah.
in 2 years.
Yep.
Okay, so let's jump in and kind of back up for a second and talk about the terminology of dividend stock, because we're going to actually talk about a lot of terminology in the show today. So the first term is dividend stocks, what I kind of just alluded to. What does that even mean?
So a company that's going to pay a portion of its earnings to the stockholders. That's the dividend.
Okay, what about dividend yield?
Well, the thing about yield, and that's something people don't necessarily understand, is the yield's going to change every day because it's based on what the stock price is. It's the percentage. Like you said in the start, you got a $100 stock, it pays 5%. That's $5 in dividend. But if it drops to 90, like your clients and people are confused about, well, you're still going to get that $5 dividend, but the percentage has changed a little bit.
So one thing we really need to clear up there, a dividend that's paid by a stock company, it is a specific dollar amount. The yield represents that dollar amount against its current price.
The relationship.
So as the stock price fluctuates, that yield will fluctuate because it's based on a very specific amount against a volatile stock price. So that yield is going to adjust up or down based on that price because we have a stagnant or a steady number.
Yeah.
If that number wasn't steady, the yield wouldn't change.
Right. And it's when a company declares what their dividend is going to be, they say it's 25 cents a share.
A share.
A share, regardless of the price at the time. It's 25 cents a share.
Many people misunderstand that. They think it's based on the value of the stock. So that's good that we...
And this is very, very important because it's the one consistency. That's why we absolutely love dividend stocks, because you can count and rely on the fact that, hey, if this stock is paying $4 a share, $5 a share, we're getting $5 a share. It's not changing, in respect to the stock price on a moment-to-moment basis. So if we know, based on how many shares, we're gonna make $10,000 estimated by the end of the year in stock cash, like actual dividend, the price is going to go nuts.
And the yield's going to go nuts.
And the yield's going to go nuts. But what do we know? We're going to get $10,000 at the end of the year, by the end of the year.
Right.
And we can count on that fact. And that's not even paying attention to the fact that the company might increase.
I was just going to say, people forget that dividend each year is going to increase. So not only is it pretty darn predictable, but it's going to grow as well, in
That's the
addition
hope,
to the
right?
capital,
Yeah.
right?
Yeah, and that's that dividend growth investing style, is looking for those companies that not only pay the consistent dividend, but they're continually increasing it each year over time, which is what we like.
And the amount of years they've done that, like just the amount of years they've not only paid the dividend, but increased it, is remarkable on a lot of these companies.
You mean like a stock just not only paying, so we keep going back, I'll keep going back to this $5. So in one perspective, it's okay, I'm paying $5, I'm just going to keep paying $5 year over year. But what we're referring to here is companies that grow that dividend, where it's $5 today or 5 years ago, and then 4 years ago went $5.10, and then the next year $5.20.
And that consecutive increase,
because you also
continuing to build.
You also have the other side where companies, their dividend is all over the place. They literally just pay a portion of their profits, and it can go up, down, may stay the same, may be huge dividends one year, and then it could be almost nothing the next.
And
so they consistently pay a dividend, but there's no consistency in the amount.
And that's one of the things that I really want to tackle in the show today is the difference between chasing a high yield, because so often we'll even have our own clients that I feel like have a really good understanding of what we're talking about, but they're like, well, there's other stocks out there that pay 11% yield or 12% yield
today
versus a stock that's paying 7% that hasn't missed a payment in 50 years. That's increased that dividend for the past 35 of those 50 years. That strong, steady, stable cash flow, that dividend's not going anywhere versus that 11% yield that's just paid it for the last year because their stock price got crushed by 60%, which made their yield fly up in the air. And you're like, well, wait, there's more to this story than just a specific yield. And one of the things I want to talk about in regards to this is an analogy. And actually, last night there was awards at my son's school, my boy's school, and the speaker gave a really cool illustration that I'm going to totally rip off and relate to what we're talking about. And he started out in this section of his talk, and he said, "Has anybody ever heard of this? The biosphere? You guys know what that is?" So, do you remember the movie way back when called The Biodome?
Oh, yes. Pauly Shore.
Pauly Shore. So, the biosphere is that. It's this enclosed environment. It's in Arizona, at least the one that movie.
Really? Oh, there was one in the movie. I remember people in there for years.
Okay. Well, this is actually for the same thing.
Okay.
And scientists wanted to recreate the ecology or, atmosphere of the Earth in this closed environment. And over decades, they've been able to grow and do all these really cool things. And one thing that they didn't expect to happen, which had happened in the first decade, was what they discovered from trees. And what they realized when they were going to grow trees in this enclosed environment is that these trees grew faster in this environment than they do in the real world. What they didn't realize was going to happen is as these trees sprouted up and grew, significantly faster, not all of them, but a lot of them, they would grow for a couple years and then all of a sudden they'd just fall over. Like these gigantic trees would just sprout up and they're like, wow, we're unlocking the secrets of the universe. You can just hear the narrative. And then year later, the tree just topples over. And it had nothing to do with roots. Oh. That was my initial reaction. Sitting there, I'm like, he's going to talk about the roots, tangled in the roots. Because you hear about the redwoods, and the strength of redwoods is in numbers, and they tangle the roots and they get strong. And it had to do with wind.
I was going to say, there's no stress on the trees.
There was no stress.
Yeah.
And they said, strengthen it. And there's this really long, 17-letter word that I'm not even going to pretend to remember. But they basically said that the effects of wind strengthen trees. And in the guy's talk last night, he talked about that in a sports analogy. But here, I'm going to talk about it in a stock analogy. And it's so easy for us to get caught up in that just quick growth, but there's no stress in the stock. And you and I have talked many times about, this stock or that stock and chasing or, hitching our wagon on that growth. We're like, there's just no stability behind it. And, and you and I talked yesterday or with a client, through email about, losers versus winners. And sometimes the losers over time turn out to be the long-term winner because of that stress, because of the fact that these stocks pay a yield, a dividend, and those dividends get reinvested when it looks bleak. But the real reason for the depressed value is all the reason to keep that stock over the long term. And then when it does rebound, and what's the plant that doesn't really show any growth for 4 or 5 years or 10 years, and then all of a sudden in 2 years it grows? Isn't it like a sunflower?
Oh,
not a horticulturist?
Yeah.
There's a specific plant, and I think it's a sunflower, where when you plant it, it does nothing for a long period of time.
Okay.
And then over the next like 6 or 9 months, it grows like 15 feet.
It does. Yeah.
Oh,
It
but
has
that
all its
time
growth.
while you're waiting. Oh,
Where it's just like it's bleak, and I'm sure everybody be like, it's not this, it's whatever. I'm sure I'm wrong. Whatever the plant is, it doesn't show anything or very little, and then all of a sudden it just explodes. And that's when you pick a really, really good stock and you hold on to it, and there's wind and volatility and just the stuff that stinks. Nobody's happy about that, but the strength it produces it is real. And that's where this biosphere has discovered, like, when you put stress into something, it strengthens it and you see the problems. But when you take that stress away, it's instant death at some point, and you don't see it coming. And they didn't. They were like, all of a sudden, they're like, well, how is this tree falling over? The roots they look like they're legit, but it didn't know how to handle any sort of stress. And sometimes when you chase legitimate stock growth, there's been.
That's why it's so important to own a good, solid company, because you look at the marketplace. What's it do? The volatility is just incredible, and so much of it's just emotion. So if your good company happens to go down in price, and we always talk about that's a great opportunity to buy more shares, then when it comes back, you're ahead of the game.
Absolutely. All right, let's talk about some misconceptions, but this is going to be specific about the allure of high dividend stocks. So we kind of talked about this a little bit. So first misconception is higher dividend yields are always better. What do you have to say about that one?
Well, we kind of talked about it a little bit, where you can see that high yield for maybe 1 year or 2 year, but that doesn't necessarily mean that the company's super healthy.
No, it could be a red flag that the market recognizes, well, that company's worth 50% of whatever it was, and now
That's right.
you're getting that 11%, but for how long?
Yeah.
Will the company last? Will they cut their dividend? There's all kinds of negatives potentially.
And when you're managing a portfolio of dividend stocks, yield is definitely something you look at. And it's hard sometimes to like cut your brain off to the attraction of, well, that one pays 15% or that one pays 10% or whatever it is. And you're like, but why is it paying that? What was the stock a year ago or 6 months ago or 2? Why is that all of a sudden artificially? Are they trying to attract? Are they in debt? What did they do to get themselves in that position, and how long have they been in there? Is it sustainable? What's the payout ratio? I mean, there's so many things you can dig into. If you don't dig in, the allure becomes so strong.
Right.
Is there a reality behind that? Like, the misconception is that what's the reality?
That's
Right.
Even with dividend stocks, you don't just buy and hold and expect everything to be hunky-dory.
Because not every dividend stock is going to be a great stock.
You have to do your homework beyond just what people see with that percentage, and so many people just look at that percentage. But another misconception that I hear all the time, especially amongst my younger clients, is dividend stocks don't offer that capital appreciation. And what people fail to see sometimes is that income is also part of the growth. And then that power to reinvest that dividend, especially, it allows for continued growth. But companies that are able to pay these stocks, and to Kyle's point, a lot of times they can't be consistent. But the ones that not only pay them consistently but are increasing them, those are pretty darn good companies that over time are very strong on a lot of different fronts. And those are companies that are going to grow over time. And those dividends continue to pay out, are part of that growth. And people just can't get past that if they pay a dividend, they don't increase. They just don't increase.
It kind of depends on your definitions of some companies, like Apple and Microsoft both pay a dividend.
Yeah.
Right.
That's funny. You're going right where I was going, but let me completely obliterate this misconception.
Okay.
So if you look at the S&P 500, which is the gold standard of market indexes right there, it's 500 of the largest companies in the world. When you judge a return, everybody goes back to this. Why? Because it's averaged over 10% a year. I mean, 10% a year, that means your money's doubling every 7.2 years. You're like, man, who doesn't want that? Yeah. Well, if you look inside of the S&P 500, about between 60 and 70% of those companies pay a dividend. That means 30-some% do not pay a dividend. Okay, if you take just the dividend out of the S&P, what percentage of that 10% annual growth would you lose? Now, most people,
right?
well, most people think, well, what's the yield? It's like right now, it's like 2.5% or less than 3%. You're like, well, it can't lose that much. So most people would go from 10 to 9.8, you know? Well, the reality is if you go back to its inception and you take just the dividend, which is only 60-some% of the stocks. So it's not even, you're not effectively hitting all 100 or all 500 positions. You're only hitting 2/3 of them. And the index loses 51% of its total return. That means it goes from 10 to 5. And all you did was effectively take the yield out. So this misconception that there's no capital appreciation is busted. What was that? That show on TV, you know, what was it called? Busted?
Mythbusters.
Mythbusters.
You know, this is the reality is that's a lie.
Yeah.
Like there's no reality to that whatsoever.
Yeah, you got to fall in love with the drip.
You do.
Yes. That's a good way to say it.
Reinvesting the dividend, because even whenever your stock prices are suppressed, you're buying more shares. So it helps your dividend through creating more income, but then whenever the stock actually takes off, you have more shares that are moving up.
That is one of my favorite things.
Yep.
Yes.
All right, misconception 3. Dividend investing is only for conservative older investors.
Don't look at me.
Just about to tee that up for
We're all
Charlie.
looking at you right now, Charlie.
Is that true?
What would you say?
Yeah.
Well, I kind of like them. But I don't know that that's busting the myth right there.
Well, okay. Let's look at this from two sides of the spectrum. So from what would the allure be for an older individual, and what would the allure be for a younger individual to bust this misconception?
Well, that used to be my myth. I mean, before I got into working here at Insight, you know, I managed my own accounts, and I always looked for the flashy, the only growth, who can grow my pie, you know, the nest egg as big as it can. I never looked at dividend-paying stocks, didn't really care about them. And I think some of that was because they're not sexy. Like most of these companies have been, you know, it's Coca-Cola and Johnson & Johnson. Like it's these companies that have been around forever. You don't think they're mature companies, right? You don't see this kind of out of this world growth that happens.
Or the potential, because they're already there, right? They're already there.
This out of this world growth
They
potential,
can be there.
Yeah,
I mean,
they are there.
And it's consistently there. So
The great thing about them, they've been around a long time and they got some free cash flow. That, you know, they can afford to be where they are.
We're going to talk about that in just a little bit.
Yeah.
Well, but so going back to your question, when you talk about the younger investor, I think so often people discount that reinvesting and that compounding and the over time of just that building on itself, and reminding people the future value of not only the stock, but then that dividend being reinvested, that compounding factor for the younger folks.
What was that? The eighth wonder of the world? Compounding interest?
Compounding interest.
Yeah, so compounding dividends.
That's the ninth wonder.
Yeah.
Well, the thing that there's so many layers to that, because, you know, this understanding of compounding of interest, you know, which we're not going to get into, but then you add the complexity of the volatility of stock with a consistent payment of dividend, you get such a double down effect.
Best of both.
Because you have this consistent yield, you have the compounding interest, and then you have the privilege of buying low because of that volatility. You also have to buy high, but you buy low because typically people will run away from dividends at the wrong time because they're chasing something else, which depresses that stock. And for those that are left, they're buying gold at a discounted price and get the benefits of the eighth wonder, the 10th, whatever wonder of the world, you know, and you're getting this compounded, cheap compound. Like, it's unbelievable. I mean,
but I'm afraid here in the United States, we just have that culture of instant gratification. I want to see the 25% bump this year in whatever growth stock there is, even if that company isn't making money at the time.
And a lot of them don't.
And that's the thing people don't necessarily realize. Oh, this has grown in price, 200%. but they haven't turned a profit yet.
Yeah, there's nothing
there's
supporting
so
that.
much danger behind that.
And we haven't even talked timing of when you need it. And if you have something catastrophic happen in our world and you need something, it does. If it's low when you need it, it doesn't matter what it was 2 months ago. And a lot of these high growth potential stocks, it's that chance, it's that instant gratification. But what you're not thinking about is when you need it. If it's not at that point, it doesn't really matter what it is in that highest time. Does that make sense?
Yeah, one thing that's very interesting, if you look at dividend companies, most of them are those stable, boring, consumable products, like energy or food or clothing, things that there's always going to be a need. And I have noticed in the last probably decade and a half, 2 decades, that more and more technology companies are qualifying for that because our life, our business, everything runs on that.
Right.
So technology, which is the fastest growing segment of the market in the last 20 some years, more and more of those large tech companies are becoming stable dividend payers, like a Microsoft and Apple. I mean, neither one of those companies has ever missed its dividend since it's paid it. And they are steadily increasing their dividend. And yet these are flashy tech companies that are, who knows how much longer they're going to do that. It's going to probably be a long time. And yet they're stable companies that pay strong yields, maybe not so much on the Apple side than Microsoft.
Some of it's just the stock's gotten
so overinflated.
Yeah, but Microsoft is almost hitting that aristocrat status, which we'll talk about later. Yeah. But
all right, all dividend-paying companies are financially stable.
I think we talked about that. It's not really true.
No, there's so much more. I mean, we can blow through that one. Just because it's paid a dividend, even a dividend for the last 20 years, doesn't mean anything, or 50 years.
Yeah.
Companies can change really quick. They can get a bad CEO. They can take a bet they can't afford. I mean, companies can change. You're only as good as your cash flow.
And we've seen companies like take out loans
to pay their dividend
just to try to stretch it.
It's not sustainable.
Yeah.
Right.
Oh my gosh. All right, misconception. Last one. Dividend stocks are safe and don't require research.
Yeah. No.
I think we've made so many jokes there.
I was gonna say,
we can just flat out say, no, the reality is you better know what you hold, why the company's paying it, how strong they are financially. If you really want to understand the strength of a company, don't look at its chart, don't look at its stock, look at its financials. And that's what we're going to dig into right now. All right, so let's do a deep dive. Analyzing financial health. So here's some terminologies that we're basically going to talk about the definition and the importance. First one, let's talk about free cash flow. What's the phrase, follow the money? If you want to find the corruption or whatever, follow the money. Mm-hmm. If you want to find the stability of a stock or a dividend, follow the cash, follow the money. And what I mean by that is and there's a lot of terminologies that we're going to go over here. Free cash flow, debt levels, payout ratios, future growth potential. And these are just a sampling of some of the things that you might want to look at and that we look at. Free cash flow is one of, if not the most important thing to look at when determining a stock dividend's payability. Because you're looking in the books of a company and you're seeing how much readily accessible cash do they have after everybody's been paid. Mm-hmm. And that free cash flow is what they use most often to pay dividends. You don't want to find a company that has to take on debt.
That's right.
Or leverage something to get the cash.
Negative numbers in that cash flow column.
That's a major. Now, I don't want to say that's always bad.
Right.
Because there could be a merger, there could be acquisitions where short term they know they're going to have to do X to pay Y. You have to understand, dig in. But free cash flow is almost an immediate, thing you can look at and go, that company's super strong. They always have, $500 million or $1 billion in free cash flow or several billion in free cash flow. And their dividend is X. And they got this much in free cash flow consistently. Yep. That's a strong company. Follow the money. Yeah.
Well, it's like you can relate it to your own household. You want more money coming in than your expenses. Yeah.
Right. And the dividend's just an expense to the company, right? So whenever you're looking, like when you're looking at charts or their inputs, it's free cash flow. Whenever you see that number, is that after they've already paid out their dividend?
Depending on when you look at it, yeah.
Okay.
But one of the things I'll say, like, what's the difference between a stock that pays out a dividend versus a stock that doesn't? Do you know what the difference is? So you have a dividend payment. What's that dividend represent versus a company that doesn't pay it out?
Them not reinvesting into their business. Like they're those high growth companies, they want to continue to reinvest in their business to make it grow faster.
Yeah. There's a lot of factors. There's a lot of different reasons. Where I was going was the growth companies want to take every dollar to leverage that to grow, and what they're going to give their investors is an appreciated stock value. Right. So they're placing a bet that the money they reinvest will immediately gratify that stock growth, versus a dividend where they're saying, hey, we're not going to take that bet. We're then going to pay out to the investor instead. So we're going to take a percentage of our growth and we're going to leverage it to grow our stock, or we're going to take a percentage of our growth and we're going to leverage that to benefit our investor. It's the same thing.
Yeah, well, you're part owner in the company.
Yes.
Is the company going to pay me that dividend, or am I saying, all right, you just take all that money, reinvest it.
In the business.
I'm banking on tremendous growth in the future.
Yeah. Either one, you're banking on the fact that, hey, I'm going to get cash, or they're going to leverage that cash for gain.
To grow
to grow.
Right.
And sometimes investors split on the growth side because they're like, all the bets they're taking aren't working.
Yep.
They're not growing. And then there are examples where the bets that they're in, I'm going to name drop here, like Facebook. Facebook stock recently has just exploded, and every bet they're taking isn't working. Like, they're putting billions and billions and billions into what? Not AI. They're putting a small percentage into AI. They're putting a huge percentage into this visual.
They did their metaverse.
VR.
Yeah.
And they have not made a dime. They actually, I think, of all the money they spent, which is over 60 billion, they haven't returned any. Like, I think the total sales, we'd have to look that up, is less than 10 billion, and they spent 60.
That goes back to the previous.
And then what did they say in the last quarter of the earnings?
We're going to do a dividend.
Not only are we going to pay out, which I'm not against,
right,
but we're going to double down, and we're going to invest even more. We haven't turned a profit at all. We've had to shed staff to show leverage cash
anything.
to show anything. And in a result, we're going to double down and pay even more, and their stock price exploded. Show me, and when you look in the books, and everything that we're talking about here flies in the face of exactly what's happening with Facebook. I'm not saying Facebook's a bad buy, but I am saying what we're specifically talking about here, and they have a lot of free cash flow, but the bets they're placing aren't working,
right?
At least yet. Now, that's not to say they won't,
right?
But they're not working yet. And that is a major red flag to an investor or a manager.
Well, it's kind of investing versus gambling. You're just not sure what
now,
you're looking at.
It could pay off, but I'm nervous about it.
Yep.
I don't think they're in any bad position to not pay their dividend. And they're such a profitable company, they can quickly turn it around. But the leadership, in my opinion, is burning money. And I don't understand why they're not putting it. They have so much free cash flow. Put it into something that's making money.
Right.
And when you look at the demographic of Facebook, it's what? It's getting 50, 60.
I was going to say, don't look at me again and talk about age.
So there's a defined window.
Yeah, they're
of
losing the younger generation.
They're losing.
Yeah,
well, no kid that I know of is using. They don't talk about Facebook. They don't even have an account.
Yeah, I don't even use it anymore. Like, it's my parents that use it.
That's all.
Yeah.
So they're phasing out of because that's their customer. That's the eyeballs that they got.
Yep.
And when those millennials pass through, what do they have? Where's their customer? So they have, and that's why they're banking on this, because they're chasing this
That's
younger.
a good point, Paul.
But even to my kids that own that stuff, they go into fat. They use it a week a year. There's no usability. There's no consistent user. Even now, Apple's got into it, and we'll see how long that lasts.
Sure.
Yeah.
And everybody's getting sick.
But Apple has all this content that they can put through there where you can watch. They've partnered with NBA and they've got movies that you can watch through it. Facebook has, to
They
my
have all
knowledge, they do
Yeah,
have
they
content. Okay.
But
Oh,
you get sick.
Yeah.
You sit in there like, because we own 2 of them, and you would do it. You mess around with it for 2 days, 3 days, and you're like, I can't handle this anymore. It makes me sick.
Oh.
All right, move on. Free cash flow, debt levels.
Keep it.
So debt levels. What we got here? Help me understand. What's the debt level?
Well, it looks like that's going to be referring to the total amount of long-term and short-term debt that company holds. So that's going to be a heavy weight on their ability to pay a dividend potentially.
And that's a big factor when we're managing stocks, is understanding how much liability a company has. So that free cash flow can be super strong, but that's just because they're ignoring the fact that they're crushing debt on this side. And you're like, oh man, they got this elephant in the room. At what point is that going to start affecting?
They have to pay interest on that debt just like our government does.
That's
but
right.
They can't print money to bail themselves.
See what he did there?
Just raise the level.
All right, payout ratios. What do we got here? What's a payout ratio?
Wasn't it the percentage of the dividend that's paid out to the shareholders?
Yes.
And then that whole are you at the right number? If the number's not at the right percentage, are they able to continue to pay that out over time? Right?
Yes. So you don't want a super high payout ratio.
Over that
basically.
60 to 70%.
Well, it's related to the earnings per share. So dividends per share divided by the earnings per share. So if you're paying out more than you're earning, over 100%, then how can you sustain that?
Right.
You can't.
No.
Yeah,
Right.
that's where those red flags start coming
But
up.
again, there are short-term reasons,
Sometimes,
like mergers. Like I've seen
Yeah.
a stock, and we've owned stocks that had 265% payout ratios.
Mm-hmm.
What happened? Well, they just merged with another company,
Who had a
or
bunch of debt.
they paid off a ton of debt. They had huge earnings potential, tons of free cash, and they took it a huge percentage. And they either bought back shares or they paid down debt, which short term crushed their ratio. And they're like, well, everything flipped upside down, and now it's 200, 300%. And we looked at that and going,
Yeah, but it's
what
only
just
short
happened? And we're like, oh, okay, we're good. We're good.
Actually, long term, this is going to be great.
Yeah. They actually positioned themselves very well.
Yeah.
And then, we're like, oh, phew.
I remember you saying that a lot during the pandemic and coming
Just
out of
after it.
where a lot of these companies were sitting on a lot of cash and they just continued to pay down debt and buy back shares. And you were like,
And we
whoa,
saw all
you were
upside
so
down.
smart.
I thought they were going to be dumb.
Yeah.
I said repeatedly, they're going to pay out extra dividend and they're going to make their investors so happy. And they did just the opposite. And I was like, they were wicked smart.
Yep.
We didn't even see that coming. But that inverted a lot of numbers and caused panic for us, and it actually ended up being some of the best stock years we've
So
had.
now they're really strong.
Stronger.
Yeah.
But sometimes they tried to leverage that and place some bad bets, But I think all in all, most of the companies kind of
Oh, yeah.
and positioned stock, paid down debt, did some really way smarter things we anticipated. We thought they were going to be like government, like just burn and churn, and be out way worse, and they weren't for the most part. They did some smart things. Future growth potential. What do we got here?
I mean, I think that's whenever you really look at holistically these companies and you look at their revenue, their capital, and do they really have that potential to increase their share price and their dividend?
Mm-hmm. Yeah. All right, so let's skip forward because I went on my Facebook tangent. So let's land this plane in this last segment here, and let's talk about understanding dividend aristocrats versus hidden gems. So what we're talking about here is, if you do any type of research on stock dividends, you're gonna stumble upon pretty quickly this concept of a dividend aristocrat, which is basically a super old company that's been paying its dividend for a super long time. And an aristocrat typically, and this is why dividend stocks get this mentality, just slow growth on their stock price and this consistent dividend when they go nowhere. And it's because of this aristocrat. The hidden gems are a little bit different. Hidden gem isn't that aristocrats are bad, but where we can have a solid yield with a strong paying company with good cash flow, good debt ratios, good payout ratios, and yet strong potential for stock growth. So let's talk about this. So, and I kind of did this. What else do we want to add on defining what an aristocrat is?
It's the 25 years
25
of
years, right?
consecutive growth in the dividend.
Well, they've got to
By
be
definition, I didn't say that.
they've got to be in the S&P 500, right?
Typically, yeah.
Typically.
Yeah, because you're going to be one of those larger,
Huge
companies.
large cap.
Right, that
yeah,
market
large
cap.
cap
Yeah.
company.
Sometimes you wonder, is that something I just want that title? What if I pause my dividend increase 1 year? So I fall out of the aristocrats, but that may be a great thing for the company as a whole and long-term dividend payout. So.
Yeah.
Yeah, I'm all for that sometimes. You know, there's been stocks in our own portfolio that have done some crazy stuff, and we have to make that decision. Do we bail on it or do we hold on it? And more often than not, we will pause and say, hey, we're gonna hold it.
Yeah.
And sometimes we made some bad decisions and the stock gets crushed and we're like, shoot, now what are we gonna do? And we're like, well, doesn't make sense to sell it. We're not going to buy any new. We're just going to hold it in the portfolio. And I'd say more than 50% of the time, that's actually worked to our benefit.
I think so.
Yeah.
I think so.
Because you got to think back to why did you originally purchase it, right? It's not like you bought it for the flash in the pan to begin with the first time. So
let's say the company lost half its value and cut its dividend in half. Well, now that looks like a perfect opportunity for me to buy something.
Right.
You know, it's still got the 5% dividend and it's cheap.
Well, that's the thing that stinks.
So
when we've bought in the last couple of years, we bought some stocks. I felt like on the top end of the growth, strong yield, and then we just rode them down the hill. What do you do in a situation like that? Because you write it down, and then every indicator, every economist, every dividend company that you look at, you research, says it's a buy.
Mm-hmm.
And you wrote it down, $30 a share, $50 a share, whatever it is a share, strong yield, good cash flow. And you're so angry because you just lost X% of your principal, and every client is like, get out of it, and every investor is like, get into it.
Right.
Yeah. Right.
What do you do?
I mean, that's where I guess you got to really go back to those notes of like, why did we buy the company in the first place? You reevaluate, and if everything is still true, then
hold
you're going to hold it.
Yeah.
And especially if you're in a reinvestment phase where you're not actually pulling out income.
Right.
Your clients and the people that we're serving, like they've been able to reinvest that dividend the whole way down.
Yeah.
And now they're set up for some
Long time.
really great.
But that's why individual investors and many money managers lose their shirt because they get emotional about it. And we're getting out. I can't afford to lose anymore.
What do we call that when every stock passes our test, our filters? Then you always say we got to do the
sanity check.
The sanity check. Yeah. That's what I was looking for.
Okay, everything looks good, but
human element of a non-biased, non-emotional sanity check on everything.
If I walked into the room right now, evaluated this stock, and didn't know any of the history, what would I do?
And looking at, and a lot of times when he's referring to the sanity check is, what are these stocks in relations to an industry, to a future growth potential? The sanity check of who are they and what could they do apart from what we know about them.
Gotcha.
So the sanity check of like electrical cars, where's that headed?
Mm-hmm.
Or energy, where are we headed from renewable energies or things like that.
Mm-hmm.
So the sanity check isn't number based as much as it is maybe even a little guessing
or something.
Trends.
Yeah.
Yes. So and
like
that's
what's happening in the bigger
world.
picture.
That's basically like, hey, we're looking this way.
Right.
Now let's look this way.
Yeah.
And just forget what we knew over there. And sometimes that's really been beneficial for us.
Absolutely.
His little sanity check.
Love that.
So, all right, last thing. I think let's talk about the hidden gem approach. So who wants to kick this off? Under recognized companies, like how do you dig in? So really, let's land this plane giving our listeners like the best benefit, because this could be a huge, this is totally in contrast to the aristocrat, those boring non-growth, which is we've already blown up that misconception.
Right.
But where can you get some tremendous potential in hidden gems?
You
and
may
how do
have
you figure
Small
it
or
out?
mid-size.
Alluded to it even with what you were just saying, that sanity check. Like what's going on in the world right now? Where is industry going? I think 3 or 4, maybe even 5 years ago, cobalt and EV, like that wouldn't have been something that we may have been talking about as potentially looking for opportunities to own companies that are in that space, that are building the batteries or that form of energy. And now that's something that we're looking at, right?
What I thought is a perfect example is you're talking about March of 2020 when COVID shut down most everything,
Right.
and all the energy gas stocks just plummeted.
Tanked.
And
we
you
knew-
think you're well, it's going to come back.
Right.
There's no question
It's not like people aren't going to go back to
Right.
work
Yeah.
and drive again.
Right.
I mean, we all panicked. I don't think I filled up my car for like 2 months.
Well, there were people, hoarding gas and
Remember toilet paper?
Yes.
I mean,
my
that was
gosh.
insane. We're all like, I
It's
got like
still,
3
I
rolls
can't
left. I was
Yeah.
freaking out.
Yeah.
I found some.
I still find myself doing that. It's like, I need more toilet paper.
That was a
was
unexpected
something.
freak out.
But we're kind of looking for some of those smaller or medium-sized companies in some of the industries with some of that insight, but maybe have some of those aristocrat qualities, but those smaller or mid-sized companies that haven't hit the levels that a lot of these aristocrats have hit.
Well,
right?
this is
catching them on the front.
Yes, I totally agree. This is where volatility, I feel like, can really be your friend. An aristocrat, by its very nature and size, where it's at, is not going to have these massive 30, 50% swings where these hidden gems are. They're going to be smaller cap companies that could get crushed in a year, might be down 30%, 40%, and where immediately will turn somebody off. And you have to step back with your sanity check and go, well, why is it down?
Well, it's
What's
a lot
going
easier
down?
for $1 billion company to double than $1 trillion company. So that's just the nature of the beast.
It is.
Yeah.
So what nugget could we give an investor here to really understand how to go find a hidden gem? Not everybody at once.
Yeah.
How would you place your bets here?
That's a tough call.
Mm-hmm.
Because unless you're looking at all the details or the
You kinda gotta
trends
know
that
what
are
you're-
happening,
Mm-hmm.
how do you exactly know? Is that 7% dividend sustainable? There's all kinds of questions about the characteristics of any hidden gem. Is it legit or
Well, and
is it
being
fool's gold?
disciplined enough to not just jump at some of those percentages of the like in looking at larger than just the sexy couple bullets that you see when you look, and being disciplined enough to look at all the different metrics before you just jump in, because there is a lot of volatility and risk, and understanding your future plan. But I think the discipline and not getting caught up in the potential and really making sure that it's got the things to truly deliver that potential.
Well, I think we gave them the model to follow. We talked about the financials, free cash flow, payout ratio. We talked about that. We talked about what it is to be an aristocrat. We talked about, what a potential hidden gem would look like. We talked about misconceptions. So if you rewind everything here, re-listen to it, we actually gave you the whole model that we use, really. I mean, we didn't go into all of the details. But if you go get a list of every stock, what is there, like 5,000 companies in the United States or around the world that pay a dividend? Which, by the way, side note, squirrel here. What was the first company to pay a dividend?
Shook always tells us that. Dutch Indies or
Dutch
something
Indies in what year? Do you remember?
Like 1600s or something like that?
1692?
1602.
I think it's in here somewhere.
Yeah, I'll have to.
Yeah, 1602. Dutch East Indian Company. And I want to land, I mean, we're going to finish this, but the first dividend, or first company to ever pay a dividend was in the early 1602 hundreds. I mean, dividends have been around for a very, very long time.
Yep.
This isn't a recent thing in the last 30 years or 50 years. We're talking 400 years of companies paying dividends, which is insane. And then just to finish that thought, if you look at the cash, do sanity checks, look at all the financials, be cautious, be disciplined on your model, you can find tons. You're going to be wrong. You're going to be right. And if you have enough, you'll probably see growth in both yield or percentage of dollar amount in dividend and in stock appreciation, almost no matter what the market does, right?
Yeah, but that's kind of why we have 30 positions or so in our portfolio.
Yeah.
It's tough to find and go all in on one hidden gem.
Yeah, you don't want to.
You can't do that.
Well, and it's easy to get caught up. I mean, I'm going to go back to Kyle's term on this sexy concept. Always make sure that you're keeping your personal goals in check and all the things that have to be important to you when you're making those decisions beyond just what you hear people talking about. And then keeping your emotions in check. My goodness. Sometimes you have a plan and it looks great. It's gone through the gut check or what is the Charlie check? The sanity check. And then you just can't seem to stay on that roller coaster without taking the seatbelt off and jumping off. So getting your emotions right as well. So
this has been a great discussion. I think we should end right there. And I will say, if you have any other questions or concerns, you could reach out to us. We're always around to answer those questions. Thanks, guys, for everything.
Thank you.